Hey guys, Ben here from Making of a Millionaire. I have an extra special episode for you today. We are actually going to be giving you a sample lesson from our course on how to become an index investor. And in this video, we're going to be talking about why it doesn't make sense to pick individual stocks if your goal is to maximize your investment returns. So we dive into all the reasons that the academic literature that backs up why picking stocks isn't a great idea. If you want to enroll in the full course, we have hours of video on how to get started as an index investor. The link to that is below. You also get this course for free if you're a member of the Financial Mentor program, so check that link down below as well. Let's jump into it. All right, let's start with a discussion of why invest in index funds at all. I really want to share with you guys my motivation for creating this course in the first place, which is that in the kind of financial online course space, most of the courses on investing are going to be pretty, in my opinion, garbage courses that are people that are trying to teach you the secret to picking stocks, and if you follow their formula, you'll be able to outperform the market consistently. It's just a bunch of BS, frankly. Picking stocks individual stocks is not an efficient way to invest in the stock market. Not for the average person, and as we're going to get into, not for most professional investors on Wall Street as well. The reason I invest personally all of my money into index funds is because they provide the highest expected return net of investment fees. So there is this, and all over the internet, you're going to find people who are pushing this narrative of, and they're usually selling a product that is priced a lot higher than this course is, of if you follow their recipe of picking stocks, you'll do great. What they never really include in that is the piles of academic research that have highlighted the realities of picking stocks. And to understand why picking stocks is a bad idea, let's start with the back to the fundamental piece of what we talked about, the two forms of risk: systematic risk and idiosyncratic risk. We discussed this already. We're going to discuss it a lot more throughout this course. Systematic risk. So there's systematic risk, which is the risk that the entire stock market will drop at the same time. This is usually triggered by something happening in the economy or some scary news that's injected fear. Basically, no matter where you're invested, unless you're invested in one of the few companies that is not impacted, you're going to lose paper losses during periods where the market drops when you're an index investor. That's okay. We'll get to why you shouldn't be too worried about that later on. The other type of risk, of course, is idiosyncratic risk, which is risk specific to an individual company. So if you bought Tesla stock, say, or any other stock, there's risks that are individual to that company that you aren't compensated for directly. So we don't want to be ever taking risks that we're not compensated for. And what do I mean by compensated? Meaning the expected return, the return on our investment that we would expect is no higher by picking an individual stock than it is in investing in the entire market. And this idea of not being able to pick stocks really comes down to, again, academic research. So if you've been following my writing on Making a Millionaire, you've probably seen me write about this all the time. About the efficient market theory, which was made popular by in the 60s by University of Chicago economics professor Eugene Fama, who's done a lot of research on the stock market. And basically what the efficient market theory is, it basically says that stock prices, so what you would have to pay to buy a share of Tesla or a share of Amazon, is reflective of all the information we have about these companies at the present. So not that everything is perfectly efficient, but that all of the information we know about a company is already baked into its stock price. And that stock prices move randomly, meaning we can't predict with any accuracy what the price of a stock is going to be in 3 months, 6 months, certainly not in 5 years or 10 years. There's just so much unknown information that will impact that in the future that unless you have a crystal ball, which again, many people will try to sell you on the idea that they do have the crystal ball, they don't. And without that crystal ball, having any ability to know what the price of an individual stock is going to be in the future is basically tantamount to throwing darts at a dartboard. It's really not that much different than that. So if we have no way of knowing what the prices are going to be and which stocks are going to outperform in the future and which stocks are going to lag, the most rational thing we can do is just buy all of the stocks, because we know over time the entire stock market is going to rise. And I want to leave you on this lesson with a few facts that stock pickers will not tell you. So I will link in this lesson to a paper done in 2018 by Hendrik Bessembinder. I terrible at pronouncing names, so I probably butchered that. Apologies. He's from the Arizona State University, an economist, and he wrote a paper in 2018 called "Do Stocks Outperform Treasury Bills?" And here are the really important points to take away from that paper. So basically what he did, he studied the lifetime returns of individual stocks in the United States dating back to 1926. And what he found was that 60% of all stocks from 2018 to 1926 that he studied had a lifetime return less than a 30-day U.S. Treasury bill. And why is that important? Remember why we invest in stocks. You have a higher expected return in stocks because you're taking on risk. The difference between the return in the stock market and the return of something like a 30-day Treasury bill, which is considered to be risk-free, that difference between those returns is called the risk premium. And basically what he's saying is for 60% of all stocks over basically a century, there was a negative risk premium, meaning you would have been better off sticking your money in a Treasury bill than investing in any of those 60% of the stocks. And shockingly, what he found was that 4% of U.S. stocks accounted for 100% of the gains in the U.S. market since 1926. So that is an incredibly small number of companies that are driving all of the returns. So a stock picker who is selling you on the idea that they have their crystal ball will probably tell you that they know what 4% of those stocks are going to be the ones driving the market in the future. So if you invest only in those stocks that will be driving the returns in the future, you're going to make crazy money. Again, the idea that they know in advance which companies are going to be driving the stock market in the future is BS. They do not know. They may think they know. They may have an idea. Even more likely still is they know they don't know, and they're just selling you on their service. Right? They're trying to extract money from you. So they're really, we have no way of knowing which of those, of the current stocks today or the companies that haven't even been invented yet are going to be the ones driving returns. The most likely scenario is that you're going to pick one of the other 96% of stocks and you're going to get a poor return. And if this research is any indication, you're actually going to get a negative risk premium on that. So again, this comes back to the idea of throwing darts at a dartboard. If you're picking stocks, you're just throwing a dart out there, and there's a 96% chance that the stock you're going to pick is not going to be one of the stocks that's really driving returns in the future. So I'll leave you on this lesson with a quote from legendary Vanguard founder Jack Bogle, who basically made an analogy of the idea of picking stocks and investing in index funds to saying, don't look for the needle in the haystack. Just buy the whole haystack. So really what he means by that, looking for the needle in the haystack, is you jumping in there and trying to find those very few stocks that are going to outperform the market. It's this little needle in the giant haystack, and you're trying to find it nearly impossible. And if you do find it, it will be luck. But if you just buy the whole haystack, you will get the needle, and it will be in there, and you'll own it, and you will get the benefits of it by investing through index funds.